In this video, we will compare 1970s with the 2020s, with a special focus on inflation. We will look at different asset classes and how they are affected by inflation in our quest to keep our portfolio optimized for current and future inflation rates. You see, inflation, like an unseen current, can subtly shift the landscape of your investments. It can erode the value of your money in real terms. But it's not all doom and gloom. In times of rising inflation, certain asset classes can actually shine, becoming beacons in the financial storm. Imagine waking up one day to find that the money in your pocket buys you half of what it used to. That's inflation, and it's not just a ghost from the past. Inflation is essentially a rise in prices that corrodes the purchasing power of money. It's like an invisible thief, stealthily stealing away the value of your hard-earned cash. You might not notice it day by day, but when you look back, you see the stark difference in what your money could buy then, and what it can now. So let's take a trip down memory lane back to the late 60s and 70s. This was a time when the world was rocking to the Beatles, and man first set foot on the moon. But economically, it was a time of soaring inflation rates. Prices spiraled upwards, and the money in people's pockets just didn't stretch as far as it used to. The impact was felt on every level of the economy, from households struggling to make ends meet, to businesses battling rising costs, to governments grappling with economic instability. This period of high inflation, often referred to as stagflation, was a challenging time. It was characterized by slow economic growth and high unemployment, a combination that left many feeling the pinch. Yet it was also a time of innovation, resilience, and adaptation, as people found ways to navigate this economic storm. Fast forward to today, the world is still reeling from the global pandemic of 2020, an event that has left deep economic scars. Governments around the world have been pumping money into their economies to keep them afloat. But as we all know, there's no such thing as a free lunch. This increase in money supply has raised concerns about a potential resurgence of inflation. So has this ghost from the past come back to haunt us today? Are we on the brink of another period of high inflation? Or is it just a specter, a fleeting apparition that will soon dissipate? Let's delve deeper. The late 1960s and 1970s saw some of the highest inflation rates in recent history. But how does that compare to today? The late 60s and 70s was characterized by soaring inflation rates. The inflation rate in the United States, for instance, peaked at an astounding 13% in 1979. The primary culprits, a cocktail of factors such as the Vietnam War, oil price shocks, and government spending. Fast forward to today. The world is grappling with the aftermath of a global pandemic, and we're seeing inflation rates rise once again. In the United States, data from October 2023 shows the inflation rate at a 30-year high of 6.2%. But what's driving this surge? Well, unlike the 70s, today's inflation is largely driven by supply chain disruptions and workforce shortages caused by the pandemic. Additionally, increased government spending to support economies during the pandemic is also playing a role. It's important to note, though, that the current inflation rates, while concerning, are still significantly lower than those experienced in the 70s. However, the pace at which they're rising is certainly a cause for concern. Now let's dive a little deeper into the causes. During the late 60s and 70s, the government's spending on the Vietnam War and social programs led to an oversupply of money, which in turn led to inflation. This period was also marked by oil price shocks, which had a ripple effect on the cost of goods and services. Today, the causes are somewhat different. The pandemic has disrupted supply chains, leading to a shortage of goods. This has resulted in increased prices. Furthermore, governments worldwide have pumped trillions of dollars into their economies to mitigate the impact of the pandemic, which has also contributed to the rising inflation. As you can see, we're not quite at 1970s levels, but the trend is worrying. So where are we headed? Well, that's the million-dollar question, isn't it? It's a complex and nuanced issue that requires careful monitoring. But one thing's for sure, understanding our past can definitely provide valuable insights into our present and potentially our future. In the following, we will delve into the different asset classes and how they are affected by rising inflation or high inflation. We'll look at real estate, cryptocurrencies, gold, stocks, bonds, and other commodities. Real estate has long been considered a safe haven during inflationary periods, but why is that? Let's delve into the reasons. First off, real estate is tangible. You can see it, touch it, and use it. This physicality gives it an inherent value that doesn't diminish, even when the economy is struggling. It's a resource that's always in demand, and one that we can't live without. Secondly, there's the potential for rental income to keep pace with inflation. In an environment of rising prices, landlords can increase rents over time, which can provide a steady stream of income that adjusts with the cost of living. Now let's look at how inflation impacts mortgage rates and property values. When inflation rises, it's often a signal that the economy is heating up, which can lead to increased demand for homes and subsequently higher property values. On the flip side, higher inflation can lead to higher mortgage rates, making it more expensive to borrow money to buy a home. However, if you've already locked in a fixed-rate mortgage, inflation can actually work in your favor. That's because the real value of your mortgage payments decreases over time as inflation erodes the purchasing power of money. In the end, while real estate can provide a hedge against inflation, it's important to consider other factors such as location, market conditions, and your personal financial situation. As always, a diversified approach to investing can help balance risks and rewards. Remember, this is not financial advice, but an exploration of how real estate has historically reacted to inflation. From real estate, we now shift our focus to an asset class that's relatively new on the scene: cryptocurrencies. You might have heard of Bitcoin being referred to as digital gold, but can cryptocurrencies really protect against inflation? The appeal of cryptocurrencies, especially Bitcoin, as a hedge against inflation is largely due to their finite supply. Bitcoin, for instance, has a maximum cap of 21 million coins. This limited supply, coupled with increasing demand, has led many to view it as a potential store of value. However, it's important to remember that cryptocurrencies can be incredibly volatile. Their prices can fluctuate wildly in a short span of time, which can either lead to massive gains or steep losses. This volatility is part of the reason why some people are hesitant to view cryptocurrencies as a reliable hedge against inflation. On the other hand, the growing acceptance of cryptocurrencies as a form of payment is another factor that could potentially boost their value over time. More and more businesses, both online and offline, are beginning to accept cryptocurrencies, which helps to increase their utility and, by extension, their demand. Despite these potential benefits, investing in cryptocurrencies is not without risk. They're still a relatively new asset class and are subject to regulatory uncertainties. Plus, their value can be influenced by factors such as technological changes, market manipulation, and cybersecurity risks. So while cryptocurrencies offer a new way to hedge against inflation, they come with their own set of risks and uncertainties. As always, it's important to do your own research and consider your own risk tolerance before investing. And remember, this is not financial advice, but an exploration of how cryptocurrencies might react to inflation. From the digital realm of cryptocurrencies, let's turn our attention to a more traditional hedge against inflation: gold. But why has gold been considered a safe haven against inflation? Gold, unlike paper currency, has intrinsic value. It's been desired and valued by societies across the world for centuries. This gives it a certain stability that paper currencies, subject to the whims of government policies and economic trends, simply don't have. Historically, during times of inflation, the price of gold has tended to rise. This is because as the cost of goods and services increase, people often turn to gold as a store of value. When confidence in traditional currencies wanes, gold often shines. In an investment portfolio, gold can serve as a form of insurance against economic instability. Its price doesn't generally move with the stock market, and in times of economic stress, this lack of correlation can help reduce risk. But while gold can provide a buffer against inflation, it's also important to remember that its value can fluctuate. Unlike stocks or bonds, gold doesn't provide income. It's a store of value, not a source of regular earnings. This means that while gold can help protect against the eroding effects of inflation, it's not a panacea. As with all investments, it's important to do your research and consider your own risk tolerance. And remember, this is not financial advice, but an exploration of how gold might react to inflation. From here, let's bring this discussion back to you. How does inflation affect you, and what can you do about it? We'll explore that in the next scene. As we transition from the tangible world of gold, let's delve into the realm of stocks and how they fare during inflation. Stocks can be a double-edged sword when it comes to inflation. On one hand, companies may be able to pass on increased costs to consumers, which can boost their profits. As the cost of goods and services rise, so too can the revenue of the companies that produce them. This can lead to higher stock prices, providing a potential hedge against inflation. On the other side of the coin, inflation often leads to increased interest rates. Why is this important? Well, when interest rates rise, the cost of borrowing increases. This can squeeze corporate profit margins and dampen economic growth, which in turn can lead to lower stock prices. Additionally, higher interest rates can make bonds and other fixed income investments more attractive relative to stocks, potentially leading to a sell-off in the stock market. So as you can see, the relationship between stocks and inflation is complex. While stocks can provide growth potential during inflation, they also come with increased risk. It's important to remember that while stocks have historically provided higher returns over the long term than other asset classes, they also come with greater volatility. As with all investments, it's crucial to consider your own risk tolerance and investment goals. Diversification remains key, and stocks, despite their volatility during inflationary periods, can play an important role in a well-diversified portfolio. So while the storm of inflation rages on, remember that stocks, like all investments, come with both risk and reward. As always, this isn't financial advice, but an exploration of how stocks might react to inflation. Now let's bring this discussion back to you in the next scene. As we continue our journey through various investment avenues, let's turn our attention to bonds. Bonds, traditionally seen as a safe haven for investors, may not always be the best choice during times of inflation. But why is that? Well, there's a simple financial principle at play here, an inverse relationship between bond prices and interest rates. As interest rates rise, which often happens during inflation, bond prices tend to fall. This is because new bonds issued at the higher interest rate make existing lower-yielding bonds less attractive, causing their market prices to decrease. Now let's talk about the real return on bonds. This is the return that investors get after accounting for inflation. In periods of high inflation, the real return can be eroded, meaning that the purchasing power of the bond income might be less than expected. This is a risk that bond investors need to consider. However, not all bonds are created equal. Some, like Treasury inflation-protected securities, also known as TIPS, are designed to help protect investors from inflation. These bonds adjust their principal value in line with changes in the Consumer Price Index, a key indicator of inflation. This means that if inflation rises, the value of the TIPS increases, providing a measure of protection for investors. In conclusion, while traditional bonds may lose value during inflation, certain types of bonds can provide a hedge. It's all about understanding the landscape and making informed decisions. As always, diversification is key, and bonds, despite their potential vulnerabilities during inflationary periods, can still play a role in a well-rounded portfolio. Remember, this isn't financial advice, but an exploration of how bonds might react to inflation. In the next scene, we'll bring this discussion back to you and how you can navigate the inflationary waters. Having just explored the world of bonds and their relationship with inflation, let's now change course and delve into the realm of commodities. You might be wondering, other than gold, which we've already covered separately, what role do commodities play in an inflationary environment? Well, commodities such as oil, natural gas, agricultural products, and metals can all serve as a potential hedge against inflation. You see, during inflationary periods, the prices of these goods often rise, which can result in a higher return for those who have invested in them. This is because these are tangible assets, and their value is often directly linked to the cost of production. As costs increase with inflation, so too does the value of these commodities. However, it's important to remember that commodities can be volatile, influenced by factors such as geopolitical events, natural disasters, and changes in supply and demand dynamics. This volatility can bring both risks and rewards. On one hand, commodities can offer substantial returns during inflationary periods. On the other hand, they can also experience sharp price drops which could lead to significant losses. Therefore, like all investments, commodities should be approached with caution and ideally be part of a diversified portfolio. So while commodities can indeed serve as a potential hedge against inflation, they are not without risks. As always, it's essential to do your research, understand the market dynamics, and possibly seek advice from financial professionals before making investment decisions. Remember, our journey through this inflationary landscape is not about providing financial advice, but rather about increasing your understanding of how different asset classes might react in an inflationary environment. In the next scene, we bring the discussion back to you, focusing on the practical steps you can take to navigate the inflationary waters. Predicting the course of inflation is much like predicting the weather. It's an intricate process that involves a multitude of factors, and even with the most sophisticated tools at our disposal, it's still not an exact science. However, that doesn't mean we can't prepare for the storm. So how do we navigate these inflationary waters? Firstly, stay informed. Keep an eye on key economic indicators such as the Consumer Price Index, CPI, Producer Price Index, PPI, and employment data. These factors can give you an early indication of potential inflationary pressures. Secondly, consider diversification. As we've explored throughout this series, different asset classes respond differently to inflation. A well-diversified portfolio can help mitigate risks and potentially take advantage of inflationary trends. Thirdly, consider your time horizon. If you're a long-term investor, short-term inflationary spikes might not significantly impact your portfolio. However, if you're nearing retirement or have a shorter investment horizon, inflation can be a more immediate concern. Finally, seek professional advice. Financial advisors, economists, and investment strategists have the expertise to guide you through the complexities of inflation and can help you make informed decisions about your investments. Remember, while we can't predict the exact course of inflation, we can prepare for it. The key is to stay informed, be proactive, and adapt as necessary. In our final scene, we'll wrap up our journey through the inflationary landscape, summarizing the key points we've discussed and providing some final thoughts.